Bloomberg.
People ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people.
St. Louis Fed President Jim Bullard says the Fed needs to be more aggressive in tightening monetary policy and repeated his call for rates to be above 3% this year. So our question of the day asks just that. Is faster better? Are faster hikes better? Let's ask Seema Shah, Chief Strategist at Principal Global Investors. Seema, thank you so much for being with us here. Give us your take here. Are faster hikes better? Do you agree with James Bullard?
Hi, well, look, I mean, faster hikes, it's clearly going to help inflation come down. And perhaps if you have faster hikes, then it means that they don't need to hike as much. So I guess that's a positive. But overall, I think what Bullard was suggesting is a clear negative ultimately for the U.S. economy. If you're still going to have the same terminal rate, but a faster pace of this, then I think the risk of recession certainly increases pretty drastically.
Seema, what's your base case right now? Because certainly the Fed speakers I've been listening to over the last 24 hours sound very hawkish, and 50 increasingly looks like it's the base case right now for markets.
Yeah, so I think what we're expecting is it seems likely that there will be a 50 basis point hike at some point this year, especially with inflation at this level and still rising. Now, beyond there, I would think that we would expect the Fed to hike aggressively in the first part, to really front load those hikes, and then maybe give himself a bit of a breather towards the end of the year. Now remember, if you get to where the Fed dot plot was, if you get to rates at 1.9% by the end of this year, that's just taking you to just above where rates were pre-pandemic. And if you remember, pre-pandemic, there weren't really any concerns about US recession. We had a pretty strong economy, very robust. So I do think that the US economy can handle rates of that level. It's when you get into the restrictive territory, when you get to that 2.8% level that was in the dot plot for end of 2023, then I think you have to start thinking about economic slowdown and even recession.
Seema, I'm curious about one piece of what you just mentioned, essentially that it gives them a little bit of room to breathe by the end of the year. That's my question to you. We have all these kind of recession odds being priced into the market, but if the Fed does have a little bit more room to perhaps cut rates in the future, which of course the market is pricing, is a recession still guaranteed for the United States?
Well, I think for the Fed, the intention would be to raise rates and then hold them there. They want to have that cushion to be able to cut in times of real stress. So, they only cut if the recession comes. And I think that's key. So what we would anticipate is if the Fed can get it right, they raise rates this year, they give themselves a bit of room to go quite gradually next year, and then they have this glide path. Now, unfortunately, as we know from history, it's quite rare for the Fed to ever be able to bring inflation down from these kind of heights without precipitating a slowdown or even a recession. So I think the odds are certainly not in their favor in this.
Okay, so a soft landing looks like a tough ask right now. Let's talk a little bit about what that means for asset allocation. Bonds don't look like a great investment, according to most people right now. Credit looks a little bit shaky. Equities, though, everybody seems quite bulled up on equities, Seema. Are you in that camp as well?
We're somewhere in that camp. I think we are positive for equities for this year. Right, we still think that the US economy is pretty good fundamentally. We look at the strong balance sheets, we look at the household sector, which is extremely strong to this point, and we feel quite positive about equities. Are we going to see very, very strong returns this year? I don't think so. I think we're going to see single-digit returns, so significantly lower than 2021. But as I said before, I think the concern really goes when you think about 2023. And then at that point, then I think certainly parts of equities will be challenged. And this is really the time when picking out your sectors, picking out specific companies becomes key. It's not enough once the Fed is no longer keeping rates very, very low. Not everything is going to keep rising. So investors need to become increasingly selective as this year goes in, and as this year goes on, and certainly into 2023.
Seema, I'm very glad you mentioned that you were bullish. As guys point out multiple times, I am as well. But I'm curious, though, about the other side of the equation. When we're talking about higher inflation, we're talking about higher commodity costs. But to what extent has the market actually digested the impact of that, especially to the end consumer? Things like planting season in Ukraine, for example, that still remains an unknown. The market's still very wavery on that when it comes to food prices. How much of that can you tangibly say the stock market or even the underlying economy is actually prepared for?
I think that's a great question. You know, when we think about what we've seen for the geopolitical crisis so far, is that it's going in waves, right? We start off talking about oil prices, then we started thinking about, oh, well, look, what about the overall commodity space? Then you get into food prices, and then you think about fertilizer. And ultimately, what you're doing is you're increasing that bandwidth of that impact of this geopolitical crisis across sectors and across regions. So as of today, some parts of emerging markets, some of those oil, some of those commodity exporters look like they could do pretty well from the rise in prices. But actually, when you dig deep and you start thinking about fertilizer, then I think there could be some concerns growing.
So that's interesting because certainly the trend of late over the last few years has been that geopolitical shocks have an ever sort of decreasing half-life, i.e. the market moves on from them increasingly quickly. Do you think that's going to be the case this time round? Do you think the sticker shock of this conflict is already passed, or do you think actually there is more still to come that the market isn't even aware of yet?
So I think you're right. So in previous crises, what we said, you know, we as have done a fair amount of analysis looking into previous crises, what happened. And typically, on average, you saw the S&P 500 fall 7%. It took 3 weeks to get to the trough, another 3 weeks to get back to the pre-crisis level. And typically, 12 months out, markets are up. But the times when that didn't happen, where the market really struggled for a prolonged period, was when the macro backdrop was impacted by the geopolitical crisis. Now, in this situation, of course, we have commodity prices, which is really key. But also, Russia as an economy is very much ingrained in the global economy, something very different to what you saw with Syria, with Iraq, with a number of different places. So the sanctions are also going to have a reverberation across the global economy. So I think it's not, you know, we're probably going to have a more prolonged impact of this geopolitical crisis beyond just this month. Of course, who knows how this goes on? I certainly can't predict. I don't think anyone else can. But I think we do need to be more, we need to recognize more that the impact could be beyond just what's obvious.
Seema, I'm curious about simply capital flows here in times of crisis. As you mentioned, wherever in the world you may be, there is a historical tendency to quickly go to American assets, whether that's bonds, whether that's the dollar, whether that's the U.S. equity market, tech, of course, being the heavyweights there. Could you foresee a situation where you do start to see, even in the face of decelerating growth, some of those flows come back to the United States and push the similar gains that you saw in the last couple of years, perhaps not double digit, but similar gains in terms of that's what's driving some of the equity action?
I think that the US will probably be the outperformer in this. You know, everyone relatively weak, but the US outperforming. And it's exactly what you said. Not only is the US a safe haven, but in this specific crisis, the US is less exposed. You know, it's a commodity exporter, it's more energy efficient in terms of consumption, and it doesn't have the trade linkages like you would for Europe. So I think there is a case to be made that the US, through all of this, is probably going to come out a little bit stronger relative to other regions. And certainly that should help drive performance in the US.
Seema, great stuff as ever. Always appreciate your time. Thank you very much for today. Seema Shah of Principal Global Investors. Thank you very much. Maybe that's the reason why Trini's a little bit more bullish. She's over there and I'm over here. Okay, coming up, the nickel market begins to stabilize after that unprecedented squeeze that sent prices spiking. We're going to hear from the CEO of the LME next. This is Bloomberg. So things are finally getting back to normal for nickel traders on the London Metal Exchange. Prices trading within the LME's daily limits, which of course have been expanded for the first time since reopening last week. Earlier, we heard from the LME's Chief Executive Officer, Matthew Chamberlain.
The fact that we've gone limit down for the last 4 days does suggest that that clearly the price had been inflated by that short squeeze, and it is now logical, with the situations around that squeeze having been resolved, that we would come down to a more normalized level, and obviously the Shanghai price is a good guide there. Today we'll be trading down into the with the limit ability to go down into the 26,000. And I think there is a good chance that we'll discover a price over the next couple of days, possibly even today.
Good morning, Matthew. So you've now had a couple of weeks to consider what's been a pretty hectic situation. What do you think you went wrong? And I know there are many counterparties involved, but I specifically want to pin you down to what do you think the LME did wrong or could have done better?
Yeah, so I think we've clearly been dealing with the immediate challenge, and there's going to be a lot of time for us to reflect on the lessons learned. But I think that there's a few points that I would make. The first is how this squeeze, how this position was allowed to arise, and I certainly think that we need to look more closely again at oversight of the OTC markets, because clearly this is an issue that came from the OTC markets and then impacted the exchange. Then, as has been well publicized, we have had challenges in delivering our price limit. So in order to bring the market back to normality, we needed to make technical changes to our systems to allow to limit the price going down on each day. And that's not something that the LME has ever done before. And we worked very quickly to bring in that price limit technology. And we clearly ran at that hard so that we could get the market reopened. There have been some well-publicized glitches, which I don't think have made a difference to the fact that we just went limit down each day, but clearly have been embarrassing to the LME.
Yeah.
And again, that's what happens when you have to deliver these things at speed to reopen the market.
That was Matthew Chamberlain, the LME CEO, speaking with Bloomberg's Anna Edwards and Mark Cudmore. Guy, what's fascinating to me about this story is it's bringing kind of flashbacks back from early 2020 when you started to see the markets crash so violently. And every time futures opened, you would see these kind of limit up, limit downs.
Yep.
It never occurred to me that this would happen with nickel.
So there's a bunch of things happening here, one of which I think he talked about the OTC nature of this, which I think is interesting. A lot of markets are being forced into using clearing houses. I wonder whether that's next. The other thing is, with this kind of volatility, the big trading houses are really struggling. I'm wondering whether their calls for more liquidity from central banks or others will be heeded. We certainly see that in past crises.
Yeah.
Commodities front and center. St. Louis Fed President James Bullard speaking earlier. We're going to hear from former Fed Chair Jeff Lacker. This is Bloomberg.
This is Bloomberg.
We're an hour into the U.S. trading session. A little bit of green on the screen. Bloomberg's Abigail Doolittle is tracking the moves. Abby, what do you see?
Well, Kriti, here's your bullish view here. You are right on stocks being higher. The S&P 500 up 0.9%. The tech-heavy NASDAQ up even more, up 1.5%. This after yesterday falling modestly, but remember, it follows the best week since November of 2020. So overall, right now we have this upward, this risk-on whipsaw for stocks, and you can really see it also with the Russell 2000 and the banks up 2%. Now let's take a look at what's driving the banks. And it's impressive that the tech-heavy NASDAQ is up so much, because take a look at this two-year yield. Really incredible. Over the last 2 days, up 23 basis points. That's really just amazing. Although if you recall, a few weeks ago, it was up 25 basis points in a day alone. So this huge backup in yields yesterday, of course, on the much more hawkish talk out of Fed Chair Jay Powell. In fact, it has the two-year note on pace for its worst quarter going back to 1984. If we take a look at this in the Bloomberg terminal, we will see on the quarter so far, this is just amazing. The two-year yield basically up 1.5%. If you recall, it wasn't so long ago we were talking about, will the two-year yield be, or excuse me, the 10-year yield, will it be at 1.5%? Well, here the two-year yield again matching the worst quarter, almost on pace for the worst quarter going back to 1984. And Guy, that of course was when Volcker was the Fed chair. You can see that ripple effect of his hawkish stance back then, very firm stance, showing in this chart right here strongly.
Well, Abigail Doolittle, excuse me, thank you so much for tracking those moves. Let's talk more about the Fed here. St. Louis Fed President James Bullard saying that when it comes to raising interest rates to fight inflation, faster is better. Bullard speaks to Bloomberg International Economics and Policy correspondent Michael McKee.
Faster is better, and I think the 1994 tightening cycle or removal of accommodation cycle is probably the best analogy here. That one was quite successful. The Fed moved 300 basis points in a single year and then made some adjustments afterwards in 1995. The result was that we hit our 2% inflation target over the next 10 years. The economy boomed in the second half of the 1990s. So I think this is a situation that's like that. We came out of the pandemic, it got surprised by inflation, but now what you have to do is move the policy rate up discreetly a fair amount, not to be too disruptive, but I think 50 basis point moves would definitely be in the mix. And then get to a level that we can be neutral, and then from there we can decide if we want to be restrictive and put further downward pressure on inflation. But right now we're putting upward pressure on inflation. It's the wrong place to be given where inflation is.
Well, as I noted, the markets, whether you look at swaps or futures, are now pricing in 50 for May 4th. The Fed doesn't like to surprise the markets. Should we assume that that's what you're going to do?
Well, I can't. I'm just one person on the committee. I don't know where the rest of the committee will be, and the chair has to manage that process. I thought that was a good speech yesterday that laid out the situation, and we'll see where we are when we get to May 4th.
Now, the economic data have been closely watched, but from what you're saying, it doesn't sound like it really matters between now and May, that we're too low in terms of the Fed funds rate and inflation is too high, and those are the only two considerations.
Well, that's the big picture, and I think that's right, that we don't really need a lot of more data here, but you never know in this world and in this business. You can always get surprised. Obviously, we've got geopolitical risk out there. I guess my feeling on that is that, we can't wait for that to get resolved. This could go on for a very long time, and certainly geopolitical tensions, even if the war ended tomorrow, the tensions would last for a long time. So I think the best contribution we can make is to get our house in order and make sure that the U.S. economy is doing as well as we can achieve, and that will be the best that we can do to contribute to the global situation.
St. Louis Fed President Jim Bullard in an exclusive interview with Bloomberg Television a little earlier on, speaking to Mike McKee. Let's get some reaction. Former Richmond Fed President Jeff Lacker joins us now. He's now an economics professor at Virginia Commonwealth University School of Business. I promoted you earlier to former Fed chair, so I apologize for that, Jeff. Let's talk a little bit about the current market pricing. 50 in May, 50 the meeting after that. Do you think that's about right?
If I was at the Fed, I'd be advocating for a series of moves like that. The story of the day here is that the Fed's trying to recover its credibility, which was badly damaged last year by their misdiagnosis of inflation and then the protracted delay while they cleared out their tapering process. I think that they made a big step in the right direction with last week's meeting and the messaging around that. It wasn't credible. Their economic projections don't hold together. They're not really believable, but they're a move in the right direction to indicate a series of rate hikes this coming year. I think Chairman Powell yesterday, you saw him in that speech, was a recalibration, a tightening of the hawkishness. I think he realized that the messaging around the meeting last week was not coming across well. I expect more of that in the future, but messaging alone isn't going to do this. The Fed spent the entire decade of the 70s proclaiming loudly that it wanted inflation to be lower, but it took actions in the early 1980s rather than speech to actually bring inflation down. And I think the same thing's going to be true this time around.
Jeff, I'm so glad you mentioned the 70s and the 80s because I think there's a saying out there that history doesn't repeat, but it does often rhyme. I'm curious what the precedent here is for a move like this. I mean, obviously, we've never really dealt with the pandemic at this scale before, but should we be looking to the 80s in terms of demand destruction or 1994 in terms of hikes that are bigger than 25 basis points? What's your take in terms of where in history we might see a little bit of a roadmap?
I think Jim citing 1994 is apt. Now, the Fed at that time period didn't do much at all to telegraph moves. We're in a different environment now where the game is to telegraph ahead of the meeting. But still, I mean, it's an indication that the economy could and financial markets could pretty well withstand 50 basis point, 75 basis point moves if needed. I think that precedent is there. I think that the aberration was 2004 when Greenspan bent over backwards to telegraph the pace of the move and when the moves would begin. Yeah. And so, I think 50 is not untoward.
Jeff, sorry, just to back up a little bit there. Are you putting 75 basis point hikes on the table here at a single meeting?
Not now, but, if they move with alacrity, they should be able to do it, but it could happen. I mean, what I expect to play out is that inflation is not going to come down in the middle of the year all by itself, as the Fed has laid out, as Chairman Powell described last week. I think that it's going to persist. There are a lot of forces pointing in that direction towards more inflation momentum going forward. Wages have accelerated, firms are passing on costs and so on. But in addition, inflation is not going to come down the way they think. They're going to be forced to raise rates faster, and that's going to call into question their labor market forecast. I don't think 3.5% unemployment at the end of this year and next year is at all plausible if they're going to raise rates enough to make progress on inflation. What we'll see over the end of this year, towards the end of this year, is an answer to this question. If they're faced with the choice, and I think they're going to be faced with the choice, which do they choose? Do they choose to fight inflation first and let labor markets heal after that? Or do they soften their stance on inflation when unemployment starts rising? I think that's the $64,000 question we're facing.
Jeff, I'm curious about the commodity side of the equation. I mean, we know that those oil prices have really been the key driver when we're talking about these inflation costs, but there's a lot of commodity shocks that perhaps have yet to come, that have yet to be digested by the economy and by the market. Food prices are, for one example, that I'm especially watching. How much does that factor into the Fed's decision to perhaps curtail even more of that demand?
So when commodity prices roll in, if they're transitory, they'll roll out again. What they do to inflation on an ongoing basis depends entirely on how the Fed handles it. When commodity prices are high and other prices haven't risen yet, what you'd like is for people to wait, to postpone spending until commodity prices are low. And the way to do that, at least in the Fed's toolbox, is to raise real interest rates, which increases the reward for waiting. So it's not obvious that commodity price shocks should lead to easier policy. At times they should lead to tougher policy.
Is a soft landing at this point possible, do you think, Jeff?
No. We're either going to get they're either going to get inflation down, or unemployment's going to stay low, but they can't do both. I just think that opportunity has passed them by. I think they missed the chance for that.
Jeff, how much room do they have for a U-turn here? How much breathing room have they really perhaps given themselves or will give themselves by the end of the year? I know rate cuts are priced in for 2023, potentially 2024. How much breathing room is there really?
So they're claiming mid-year inflation is going to sag. So June, July, and August, those meetings I think are going to be telling if inflation's not falling, if it's not softening as the staff's undoubtedly projecting for them, then they're going to be faced with the choice whether to tighten, increase the pace of tightening or sit tight for a while. And so they basically have until then. I mean, they'll throw in a 50 in the next two meetings, maybe two, and see where we get. But I think they have until mid-year to really demonstrate that their hope for inflation coming down on its own with their modest pace of tightening built in is actually viable.
What about the balance sheet, Jeff? What should they be doing there? Should that just be on rails in terms of the runoff, or do they have to be more dynamic with it?
I don't think they want to be dynamic, and I don't think they need to be, and I don't think they will. I think they'll put it on a faster track, but I think they'll do it in the same sort of formulation where there will be a cap on the amount by which their holdings fall any given month. If they're wise, they'll roll off the housing stuff, the mortgage-backed securities, more rapidly and get out of that faster than treasuries. But I think he signaled pretty clearly that they want to do it faster. I wouldn't be surprised at all. I'd be surprised if they don't announce a roll-off at the next meeting.
Jeff, you're an economist by trade, but I'm curious about your market take here. I think you kind of have to keep an eye on the bond market at these times. What is your take on what the bond market is pricing here? I think we're looking at 7 rate hikes throughout this year. Mm-hmm. Is that a plausible bet to be making?
Sure. I mean, I think it's going to take more than that to really get inflation under control. I think they're taking Chair Powell at his word that the committee is committed to reducing inflation and views that as a prerequisite for employment growth. So they view him as making the choice in the direction of bringing inflation down. I think that they're, at first last week, I think the markets maybe took the Fed's projections too seriously. I don't think they were skeptical enough about them. Now they're a little skeptical about how much rate hikes are going to be required. And I think that solution to the puzzle of last week's projections, I think, is the right one, that what they've sketched out requires faster rate hikes than they put forward. So I think the bond market reaction seems well warranted.
Well, Jeff Wacker, former Richmond Fed president and economics professor at the Virginia Commonwealth University. Thank you so much for your expertise and your time, as always. Coming up, what will it take for Ukraine's President Zelensky and Russia to reach a peace agreement? We'll talk with one of Zelensky's advisors, Cambridge economics professor Alexander Rodniansky. This is Bloomberg.
So the Ukrainian President Volodymyr Zelensky has called on Pope Francis to mediate in the war with Russia. In a tweet, Zelensky said he told the Pope about the difficult humanitarian situation that the country is facing. Meanwhile, the Kremlin once again said the peace talks are going more slowly than it would like. Let's talk more about those talks. One of President Zelensky's key advisors is Alexander Rodnyansky. He joins us now. He is an associate professor as well of economics at Cambridge University. Alexander Rodnyansky, thank you very much indeed for your time. President Zelensky is talking about maybe some need for some divine intervention in terms of these talks. Let's talk a little bit about where we are. You have a useful insight into the progress that is being made. What can you tell us about how far the talks have gone in terms of securing some sort of a lasting peace and how much further there is still to go?
Well, first of all, thanks for having me. So we're in the talks already. We have to give them a chance, of course. I'm a little pessimistic as far as their prospects are concerned, but there are certain issues on which we can reach an agreement relatively easy. Those issues concern the neutrality status, for example, as long as we have tangible security guarantees that are given to us, unlike in the Budapest Memorandum. So we're willing to talk about that. There are other issues that are basically non-existent but important for the Russians, something like the Russian language, let's say, so we'd never had any issues with that, so that's relatively easy. But there are, of course, certain points which are completely off the table. Anything that concerns our sovereignty or territorial integrity, that's never going to be discussed. Now, as far as divine intervention, as you say, that's good. We have to give peace a chance.
Alexander, this is Kriti in New York. Thank you again for joining us. I'm curious about a potential meeting between Zelensky and between Putin. Is that something that is potentially on the table, and do you think that could help perhaps speed up some of the progress in the talks?
Well, certainly we have to do anything that we can to speed up the talks or have any success. We have to give any type of negotiation a chance. Unfortunately, the Russian side hasn't been willing to talk to us directly. The Russian leader hasn't been willing to talk to our president directly for a long time. So we don't see any change in that in that sense, but we have to give it a try.
Alexander, do you think that the Russians are negotiating in good faith? There is an argument that says that they are talking because it provides cover to further their objective on the ground. What do you think to that argument? What do you think about the idea that the Russians are not negotiating in good faith?
Yeah, so this is my fear. I've been saying this for some time. This is in fact quite a realistic possibility because we see that what is happening on the ground is not really consistent with what they've been saying in these peace talks. You don't look for peace and intensify bombardments of our cities. These two things don't go together. So there is a serious concern that they're using these peace negotiations as a trick to deceive the West into thinking that peace is around the corner and therefore further sanctions aren't necessary, right? So this could be a sort of strategic ambiguity on their part to signal to the West that, look, we're actually, trying hard here, but in fact they're just preparing their new offensive, and this is all a deceptive move.
So what can be done to perhaps counteract that? Is that something you're waiting for in terms of sanctions? Is there more that can be done there or more from European governments? What would help, like I said, more progress?
Yes, so I think this regime has proven over the years that it respects only strength. It only understands the language of strength. It has been deceiving consistently throughout these years. We heard that there was no troops on Crimea. Next day there were troops on Crimea. In the build-up to this war, we heard this was only a military exercise, and then we saw what happened. So we can't really trust them. What we can do is put pressure on the Russian regime economically. That means increasing further sanctions as far as the revenues from oil and gas sales to Europe are concerned. So an oil embargo, a gas embargo would really help in the sense of bringing Russia's war effort to an end. Because Russia's war effort is financed through these sales of gas and oil at this stage. So that's one thing.
Why is Ukraine, okay, Alexander, why is Ukraine allowing Russian gas to transit its territory? If that is the case, if Europe should cut off Russia in terms of an energy supplier, why is Ukraine still facilitating the transit of that gas?
Well, remember, we were also receiving fees over the years for the transit of gas through our territory. So this wasn't happening for free. Now, of course, the reliance of our budget on these revenues, on this stream of income, is negligible at this stage. And of course, what we care about most is bringing Russia's war effort, Russia's war machine, to a halt. And that can be done by putting them into a serial fiscal problem. And that will be done through an oil and gas embargo in Europe.
Well, let me pick up on that topic. If you're talking about transit fees that you're actually getting, how much are you actually getting, and how much are you still waiting for in terms of offsetting perhaps some of the losses of the war?
Well, I mean, you can look up the numbers, but it's at this point, it's insufficient as far as, our actual expenditure needs are concerned. So what matters here is bringing Russia's war machine to an end. We have a serious fiscal concern too, because our economy is collapsing. We can't really put numbers on this at this stage, but we know that we've given up percentages in terms of GDP growth. So we're really facing a disaster in terms of what's happening to our economy.
Absolutely. We'll come to that in just a moment. It was interesting to hear the Germans today talking about a Marshall Plan. Before we get to that, can I just return to the issue of the talks? There is an ongoing and serious concern, and this is being vocalized by the US president and others, that Russia is prepared to use chemical weapons. If chemical weapons are used, are talks still possible?
Well, I hope this is really a red line if that happens. We've seen, episodes in the past where the red lines have been drawn in the conflict in Syria, for example, and then not implemented. So we're obviously wondering in Ukraine what else needs to happen for the world to take this more seriously. If there is the use of weapons of mass destruction, of which chemical weapons are one type, then we really hope that nobody will just sit back and watch what happens. Of course, we hope there'll be an intervention. We know that chemical weapons could be used at this stage because Russia is facing serious issues taking our cities. They can't really take our cities without serious losses to their troops or without destroying our cities. And so from a brutal militaristic perspective, the use of chemical weapons could be a solution, inverted commas, to them. But we hope this won't happen, of course.
Well, in terms of the talks, at the start of this interview, you mentioned that the territorial conversations were a hard no from the Ukrainian delegation. But I'm curious about the specific regions of Donetsk and Luhansk in particular. Are those, just given the separatist movement there, is there any wiggle room when it comes to those territories in particular?
Well, as far as we are concerned, we're not going to compromise on our sovereignty. We're not going to compromise on our territories. So there is no wiggle room, as you say. There is perhaps wiggle room to our neutrality status, although, again, we're just saying we're putting off the NATO accession talks for now. NATO has basically said no to us. We're also in the middle of a war, so as long as we're giving security guarantees, we can talk about that, but there's no wiggle room as far as our territory is concerned. And if you ask the people who live there, they're not willing to take any wiggle room. They're not willing to discuss this either.
In terms of the rebuilding of Ukraine, were we to get to a point where it would be possible, the Germans are talking about a Marshall Plan. What would that Marshall Plan need to include? What do you think it would need to look like? Put your economist hat on for a moment.
Well, of course, look, our infrastructure is destroyed. So this would have to be billions and billions, right? We need a really big program for Ukraine that would primarily, in the early stages, be focused on rebuilding our infrastructure. Our bridges, our roads have been completely destroyed in large parts of the country. Actually, they've been just built up recently because President Zelensky had a program that was really focused on infrastructure.
Alexander, do you think joining the EU would be a necessary prerequisite at that point?
Well, joining the EU would, of course, help us because, again, we would be getting funds from the EU. We'll be integrating with the EU. We'll be part of the common market in the EU. Of course, that will help us. But at the same time, we understand that this is not something that happens overnight. We also have to build up our institutions in many respects, our economic institutions, which are still lagging. So we know that. We have to do our homework, and we've been doing our homework in many respects. So joining the EU would definitely help, but it doesn't happen overnight.
Alexander, really appreciate your time today. Thank you very much indeed for joining us. Alexander Rodnyansky, advisor to President Zelensky. Thank you very much indeed. This is Bloomberg.
that all day yesterday.
Tuesday, the 22nd of March. Stocks up, bonds down. The next hour of Bloomberg Markets starts right now.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Stocks up, bonds down. Let's talk about it here in Europe. This is the price action. Stock 600 up by 0.8%, 458 now. We continue to climb higher out of the hole created by A, tighter monetary policy or the prospect of it, B, what is happening in Ukraine. Look at what is happening in terms of the bond markets. You can see it on both sides of the Atlantic. Certainly the action at the front end, that is the German 2-year. We're now negative 22 basis points. We continue to climb back towards zero. Obviously the 10-year already there. The sell-off fairly aggressive. Brent's been volatile, shocker. Today we've got it trading at 115. Now it's down. We're down by 0.4%.
Yeah, Guy, let's just talk about what's moving here in the markets because there's actually some green on the screen. You are seeing a big bounce back here in the S&P 500 coming from about a flat session yesterday. So you do see a little bit of kind of volatility, a little bit of choppiness in the market. But for today, the bulls are winning. Who's not winning? It's going to be those bond investors. And that's where you're seeing the yield hit 237 basis points on the 10-year. But it's not just the 10-year. You're seeing yields higher across the curve all the way to the front end on the 2-year through the belly. And then, of course, like you said, the 10-year and out into the 30s as well. You already hit Brent, so I'm going to slide over that. But one other big piece of the equation here is what's going on in the currency market. The dollar weakness that you are seeing spurring some of those commodity currencies. Think the Brazilian real, think the Mexican peso, but also look at the selling that's happening here in the Japanese yen. It's not just about haven flows here and that risk on vibe, although I'm sure that's part of it. You're also seeing some of these massive selling, massive moves in the yen. The people keep calling for a reversal on, and you're not seeing that manifest yet. So this is a currency cross you really want to keep an eye on, Guy.
Absolutely. Let's talk about the center of the action, though, and that is certainly what is happening with the Fed right now. St. Louis Fed President Jim Bullard speaking earlier saying that the Fed needs to be more aggressive with rate hikes. Our question of the day, to his point, is faster, better. Joining us now, Banu Baweja, UBS Investment Bank Chief Strategist. Banu, nice to see you here on set.
Good to see you, Guy.
The Fed making it clear, Bullard, Powell, member after member, talking about the fact they need to get the message across that they want to be more aggressive. Do you think that's now fully imbibed by the markets? Do you think the market has now priced that? Does pricing currently make sense to you?
The market is priced fairly aggressively, right? So you've already priced in about 42 basis points for the next meeting, and you're pricing in about 80 basis points till June. So the market is talking about 50, and if the next CPI print is aggressive, you could actually price in 50 fully. I think if you look at it over a 12-month period, the market is probably pricing in a little bit too much. We think 6 hikes this year. The market is thinking about 7 to 8 hikes through the course of this year. But the market is then flattening out and then looking for cuts in the second year. And that's where I think the market's probably more wrong, right? So in the front end, they're pricing in too much too early, and then at the back end, they're not pricing in too much. So the terminal rate's at about 2.1 right now, so 1 month forward, 5-year is about 2.1. Still 40 basis points below the Aussie, below the RBA. Given what's happening with China, doesn't make a lot of sense. So we think the market's priced too aggressively, too soon, but it's not pricing in enough at the back end. So market thinks central banks are going to go really hard and effectively drive the economy into recession. We think they're going to go slightly slower in the front end, but go for longer.
Banu, interesting stuff. When you talk about a rate hike cycle, essentially, history shows that stocks tend to rally in advance, and you also tend to see with real yields still in negative territory. Are you expecting more flows coming into equities in particular, not just in the United States, but around the world?
I think the flows into equities are likely, in fact, to slow down because your point about real yields is exactly right. Look, in the very near term, growth does remain strong despite Russia, Ukraine. Some of the hits that we could have seen from energy, the volumes have not been impacted. So fears of stagflation, I think, are slightly misplaced. So we could see reasonably strong growth over the next 3 to 6 months. And particularly in the US, you could see very strong growth. But beyond that, liquidity, let's remember, has been the biggest driving factor of this market. So as liquidity tightens, even if earnings hold up, I think it'll create headwinds for the market. So in the second half of this year, gains in the market are likely to slow down. And the key point to watch is real yields, because I think inflation break-evens are very aggressively high right now, to the point that we were discussing earlier, Guy. Inflation break-evens are very high. Inflation break-evens could come a little bit lower, which could cushion sort of the rise in nominal yields, but real yields can rise. So by the end of this year, we could easily see real yields at zero.
Okay, so what do you want to own in this kind of environment?
Yeah, it is difficult. You want to be paid in rates. I think growth equities will probably do a little bit better than value equities over the medium term. Near term, value equities do well. Across the board, I think lower returns is the name of the game. I think the correlation, this recent tension with Russia-Ukraine, I think there have been significant correlation breaks coming out of that. The data is too short, so we don't know as yet. But for instance, I think gold will be in very aggressive demand moving forward. So I think gold is one of the things that you want to be owning, because the market is questioning hard currency. U.S. Stocks, both growth and value, in fact, will do well. And in Europe, we are long financials, and we actually think that if you don't get further worsening in geopolitical tensions, the consumer is also quite cheap in Europe. So quite selective in Europe now. Financials, consumer is where we're looking at. But in US, looking both at growth and also at value within the context of lower returns. I really want to emphasize that.
What does a lower return mean?
So over the next 3 years, our equity risk premium model would suggest a return of about 4% per annum in the S&P. 4% per annum, right? And that compares with about 20% per annum returns over the last 3 years. So a significant step down, sort of 1/5 of the returns that we've seen in the last few years. Because look where growth is going, which is slightly lower, and look where liquidity is going, which is slightly tighter. Admittedly, they're coming from extremes. Growth was nearly at 100 percentile of its distribution. Liquidity was at 0 percentile in terms of extreme looseness. But now both of them are moving in opposite directions, and that's a drag on the market.
Well, we should talk about what is also dragging the market, and I should say the underlying economy, and that is commodities. Of course, you do see oil prices continuing to march higher, food prices as well. When you look at those contracts, I'm curious, in an investment portfolio, is there room to kind of include some of those commodity contracts as perhaps a hedge against those rising prices?
Yes, there is. I think real estate also provides that hedge. At this level, you know, when the curve is as backwardated as it is, I would not be going aggressively long oil. I think that it is quite important also, you know, the impact on the economy from higher oil prices, from higher natural gas prices is going to be a little more limited unless you actually see volumes getting impacted. And what's really interesting about this last episode is that through the course of the war, you actually seen imports of natural gas from Russia into Europe pick up rather than come down. So that's why it's not surprising that natural gas prices are now coming down. So bottom line, I don't want to load up on fundamentally on energy out here, but I think precious metals is what I would be looking as a hedge for inflation as well.
But equities aren't really going to perform that role. If inflation can come down a little bit, say you're getting 4% return off your equity portfolio, that's just kind of going to keep pace with what the inflation picture looks like. So it is going to be a hedge, but you're not going to outperform inflation.
No, so risk-adjusted returns are falling. There is no other way to say that, right? In the last 20 years, excuse me, a 60-40 portfolio has earned a Sharpe of about 0.8. I think in the next 10 years, we'd be lucky if we get 0.4. So both bonds and equities, the way they are moving, risk-adjusted and inflation-adjusted returns are likely to fall. There's no way to hide from that.
Manu, I feel like in some of the commentary around just how the economy is going to be progressing in the next couple of years, there seems to be this concept of decelerating growth and then an outright recession. Do we see an outright recession in the United States? And the same question for Europe as well. What's your take?
So neither in Europe nor in the U.S. are we looking for a recession. I mean, certainly the U.S., as I'm sure you've discussed many times in your programs, I mean, the energy intensity of that economy has declined significantly. It's become a producer, and so therefore, you know, even if consumption gets hit, production improves. So we're certainly not looking for a recession in the U.S. We're much more worried about what the cost of capital does to investment and does to consumption, and therefore, if there is going to be a recession, and we don't think there is, if there is going to be a recession, I think it's monetary policy that's a bigger source. I mean, higher energy prices are unlikely to do it in the U.S. In Europe, again, you should start worrying about recession when the volume of inflow, when there's an embargo of energy, particularly of natural gas, because crude oil is more fungible. If B is not going to sell to A, B is going to sell to C, is going to sell to D, is going to sell to A. So it's fungible, right? India is buying Russia oil. Iran can then sell to the West. So that's crude oil finds its way onto the market. Natural gas, much tougher. future. But so far, we're not seeing that disruption. So we're not looking for a recession in Europe either. In fact, in neither of the markets, by the way, because for all the talk of, stagflation and so on, if you actually look at what the markets are pricing, what kind of earnings downside the markets are pricing, year to date, the earnings downside that the market has priced, so the internals of the market, cyclicals and so on, is about 2 to 3%. That's not recessionary.
Well, Banu Baweja, UBS Investment Bank Chief Strategist, we thank you so much for your time and for your insights. Coming up, the EU's Foreign Policy Chief Joseph Borrell accused Russia of carrying out war crimes with its attack on civilians. We'll discuss with the former president of the International Criminal Court, Chile, Ibo Asagi. This is Bloomberg.
War in Ukraine rages on.
Ukraine will never be a victory for Putin.
What is happening is a genocide of Ukrainians.
Putin must fail.
Turn to Bloomberg for up-to-the-minute reporting from around the world.
1.2 million people have crossed into Poland.
The Children's Hospital, the latest target. Putin has gone all in.
And analysis of what it all means to you.
The corporate exodus continues.
For every dollar the United States could lose, the European Union stands to lose 10.
Keep it tuned to Bloomberg Television and Radio.
Get back and talk more about what is happening in Ukraine. Last week, President Biden didn't pull any punches. He was asked by a reporter about whether or not Vladimir Putin had committed a war crime. Listen very carefully to the answer that he gives.
I think he is a war criminal.
Will you be meeting with him?
He is a war criminal. Does Putin meet that definition for a war criminal? What is the difference between being a war criminal and what is a crime of aggression? Let's try and get to the bottom of all of this. Joining us now is a judge and a former president of the International Criminal Court, Chile Ibo Asagi. Chile Ibo Asagi, thank you very much indeed for your time, sir. We really appreciate it. Can you just give us your view of where we are in this conversation? There is a lot of talk that Putin, President Putin, is a war criminal. Can you just define what that is and how a war criminal definition is different to a crime of aggression definition?
Thank you very much, Guy, for that question. First of all, I will not be convicting anybody on television, that much we know. But your question now is a distinction between war crimes and the crime of aggression. The crime of aggression is a crime, or rather, when one country unleashes an attack against another country without a defense of self-defense or justification of self-defense, in the sense that somebody else had attacked that country and the country is defending itself, or there is an imminent attack against the country and that country wants to ward that imminent attack off. Now, when you embark on an attack without that justification of self-defense, that is a war of aggression, and a war of aggression in international law is a crime in international law. Now, that is different from war crime. War crime is basically a crime that's committed in the context of a war. War as fought, as opposed to war as such. War as fought, as somebody who is already implicated in the crime of aggression or war of aggression can commit war crimes on top of that. In addition, somebody who's also engaged in self-defense can also commit a war crime. For instance, if you are doing self-defense and then you capture the opposing soldiers who are on your territory, you're not supposed to kill those soldiers. They become prisoners of war. Yep. They're wounded soldiers. You're supposed to care for them. You don't do that. That is a war crime. So in a sense, that is a distinction between a war crime and the crime of aggression.
Sheila, can you speak a little bit about jurisdiction here? We know that Russia withdrew from the ICC in 2016. We also know it's a member of the UN Security Council. How does the ICC really operate given those circumstances?
Now, first of all, Russia did not withdraw from the ICC. Russia never became a member. Russia had signed the Rome Treaty initially, but then that's not, when you sign it, you have to do something else to become a member. They didn't get to that second point, and then what they did was withdraw the signature they already put in there. So let's keep that in mind. Now, your question is about jurisdiction. The jurisdiction of the ICC now is engaged in relation to war crimes, because Ukraine had declared that it will accept the jurisdiction of the ICC in relation to what happened on its territory. And there you have war crimes, crimes against humanity and genocide, if the prosecutor finds that those have been committed on the territory of Ukraine, because Ukraine had declared recognition of the jurisdiction of the ICC. Now, relating to the crime of aggression we talked about, that's a different ballgame. That would ICC cannot effectively exercise jurisdiction in relation to the crime of aggression, because the way that crime is described or laid out in the Rome Statute, the ICC treaty, you will require the referral by the UN Security Council to the ICC, where you have the person or the country that is engaged in the crime of aggression. If they're not a member state of the ICC, then the ICC cannot exercise jurisdiction. You must require the referral from the United Nations Security Council for that to happen. Now, that's not going to happen because Russia is a member of the P5 in the Security Council and will exercise veto power. So that now puts the crime of aggression beyond the ICC, but the war crime is fully in the cards now.
Do you worry that the accusation of war crime is being used to isolate President Putin? Do you think it's being thrown around too easily and is being used to elicit behavior in others? I'm going to label a person as a war criminal in the hope that the tag sticks and other people don't ultimately want to deal with them, regardless of whether or not they have been found guilty or innocent. Do you worry that we are using the term too liberally?
I wouldn't worry one way or the other about that. I must remain neutral. I see what you're asking, and that's a legitimate question. Is it now a political football being used? That's the question. There's no question that politicians do these things. But if you're seeing what's happening on screen, what is being portrayed on screen, you may begin to get into the territory of what you call in law, we call that probable cause. You're seeing something that looks like something. Now, of course, it tempts an intelligent person to form a view on that. That intelligent person may be a prosecutor, or that intelligent person may be a politician. But at the end of the day, Guy, the question here is, what is the world going to do about this thing? We've seen this thing before, this film many times before in the past. And up until today, are we going to stop at using these labels? What are we prepared to do in future to limit the possibility of these things happening? This is where the thing hangs for both in EU and in the US, the leadership there. What are they prepared to do? Here we are looking at the Rome Statute. Why do we have it that the ICC does not fully have jurisdiction in this kind of situation? Are the powerful countries like the US, UK, France, China prepared now to say, look, we're going to allow for people who commit these crimes to be prosecuted fully and not use the Security Council to stop it? Are the member states of the ICC, are they prepared now to say we're going to amend the Rome Statute in order to allow the United Nations General Assembly to have jurisdiction where the Security Council does not refer certain crimes that should be referred to the ICC? We saw that in Syria, for instance, it never got referred. Can we now use the General Assembly to say, well, if the Security Council doesn't do it and justice cries out to be done, then the General Assembly should come in that kind of scenario and make the referral? That is something that can be done easily if states parties to the ICC want to do that. Beyond that, how can we increase the risk of civil liability of those who embark upon crimes of aggression 74 years after recognizing that international law sees something we call fundamental human rights? We still do not have in international law something called the right to peace. Now, what kind of right can you enjoy in circumstances where there's the bedlam of war? You can't have your right to life, liberty, and security to security of the person in circumstances of a war. So we do need to recognize the right to peace. When you do that, you then create a scenario where those whose rights are violated when you have an invasion, a crime of aggression, later on, those victims would have the right to sue in civil courts all over the world and attach property and assets of those who engage in wars of aggression. That would really make it economically difficult for those who embark upon wars of aggression. These are two things that could be done: amend the Rome Statute and allow General Assembly the authority to refer cases to the ICC, and secondly, recognize the right to peace and allow victims to sue those who violate those rights later on.
Tough stuff. Thank you so much for breaking it down. Chile Ibu Asaji, former International Criminal Court President and Judge. We thank you so much for your time and for your insight. More coming up next. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ruchika Gupta. Pfizer will sell as many as 4 million doses of its Paxlovid pill for the coronavirus to low and middle income countries. It's part of an agreement with UNICEF, the global relief organization. It can cut the risk of hospitalization or death from COVID by almost 90%, according to clinical trials. The world's largest cruise line reported revenue and a net loss that missed estimates. Still, Carnival says that weekly booking volumes for future sailings have been improving since the middle of January. It's expecting occupancy to return to historical levels in 2023. And Alibaba has ramped up its share buyback to $25 billion. China's e-commerce giant is reacting to staunch a $470 billion loss of value during Beijing's internet crackdown. The government has pledged to support the economy and finish the clampdown on the tech sector as soon as possible. That triggered a historic rally in Chinese stocks. And that is your latest Business Flash. Sky.
Ruchika, thank you very much indeed. Kriti, is this Bubba buying the dip?
It might be buying the dip. It's quite a big vote of confidence on itself, essentially. Yeah. But let's put this into perspective, right? We've had the Chinese regulatory authorities, come out and say, we're going to ease that crackdown. We're going to have clarity on that crackdown. So maybe Alibaba's giving us a signal here.
Yep. Always interesting to see what insiders are doing. Always interesting to see what companies doing. And this is a big chunk of change as well. We'll see ultimately whether the timing turns out to be accurate or not. We will continue to monitor these markets. Equity certainly on the front foot today on both sides of the Atlantic. We'll turn and check those in just a moment. This is Bloomberg.
This is Bloomberg.
So the surge in oil prices dominating the headlines in financial markets, in financial news over the last few days. But the war in Ukraine has led to another commodity shock, one that we're less focused on. Russia's invasion is threatening to turn steel into a luxury commodity. Yes, you heard me correctly. Bloomberg opinion columnist Javier Blas writing about this morning. He joins us now. Javier, we were joking about this as you walked on set. You look around. Steel is everywhere. Steel is the building that we stand in, the cars that we drive in. It is the rails that are going to take me home. It is everywhere. Talk to me about the price increase that we've seen and how sustainable these price increases are.
Well, we are at record highs already in Europe for a number of different kinds of steel. The market, we usually look at hot rolled coil and rebar. Those are the two main markets. Prices have gone up between 150 and 200% from where we were before the start of COVID. It's more than double in the last few weeks. So record highs and prices that the market has really difficulty to really deal with it. I was talking to some steel service centers. This is kind of the intermediaries between the big producers and the buyers, and they say, well, I'm very scared dealing on these prices. We have never seen it. I'm concerned of being left with this stock, but at the same time, I think that prices could go higher. We have lost a lot of supply from Russia and Ukraine, and also we have to bear in mind that the cost of electricity has surged in Europe, and we require a lot of electricity for electric arc furnaces, which is one of the ways that we produce steel in the European Union.
Recycled steel,
Recycled steel altogether means that we are short of supply and prices have increased to a record high. Worse is that prices probably are going to continue increasing.
Javier, one of the comments or the conversations going on right now in oil and food prices as well is what countries can actually make up for some of that supply, whether it's the Middle East for oil, whether it's the United States for grains. What is the equivalent of that when it comes to the steel market?
The Saudi Arabia of the steel market is China. China can produce a lot of steel, but we have a problem right now, and it's the fact that China and Hebei province in particular is suffering from the COVID outbreak again there, and some of the steel production has been shut down. So China can't replace that steel that is coming from Russia and Ukraine into Europe, but obviously there is a problem. They can't replace the volume, but it's going to take time. You need to move all that steel into Europe, and we know how supply chains are really stretched. We know how expensive freight is, and steel is not something light. It's quite heavy, so it's going to be very expensive to move it. On the short term, the only response that we can expect on the European market, and that response that we are already seeing, is demand destruction and the buyers taking a step back and just not buying the steel.
What does demand destruction look like here? Producing less cars. We're not producing as many cars anyway because we've got chip shortages. Is it the building industry? Just kind of walk us through where that demand destruction shows up.
The first step we're going to see is a slowdown in construction. It may be just that rebar, which is these thin rods that we introduce in
reinforced concrete. For reinforcing concrete.
We will see a shortage of that, and the price is very expensive, and that is a very price-sensitive industry. I mean, construction projects are just going to slow down because we are not going to have the steel, or some construction companies are simply going to say, we cannot, this is something that we used to pay $400 per ton. Now the market is $1,100 and trending higher. We simply cannot afford it.
Can you speak to a little bit about the pricing there then? If there is a shortage of supply around the world, does that mean that the cars that are being produced, the few that are hitting the market, are those then more expensive simply because of the products that are required to make it?
Yeah, this is going to be another source of inflation that central banks are going to have to be dealing in the next few months, and it's one that probably is not as instantaneous as the price of gas or the price of oil, but it's one that it could be long-lasting. And you mentioned cars. I mean, the average car weight, about 60% of that weight is steel. That probably is about 900 kilograms. A couple of years ago, that was about $450 the cost. Today, it's more like $1,100. So obviously, there are two options here. Either the car producers take a hit on their profits, or they have to increase the price of the cars.
Do we need to change the tariff structure to make the steel trade globally more efficient at this point? Because Chinese steel, for instance, has a significantly higher tariff than other steel. We've still got tariffs that exist across the Atlantic. How quickly can some of this change?
Well, I think that they're going to have to start moving very quickly. But this is a reader sent me a message today saying this is the big silent commodity. There's not nearly enough attention to steel. There's a lot of attention to oil and gas markets, but I don't think that policymakers have yet realized of the problem. So, I mean, those tariffs can be eliminated quite quickly, and that could be something. But policymakers first need to see
recognize the problem.
Yeah, exactly, and hopefully this column will help.
Well, Javi, one quick question here. Talk to us about the timeline. When do we start to see the impact of that demand destruction that you mentioned maybe coming off of these steel prices?
I think that we are going to start to see the demand destruction right now at current prices, but from the executives that I spoke on the way of writing that column, I don't think that we have yet seen the peak of the market. And there are some executives that they really think that prices could continue increasing all the way until our summer and perhaps around June, July peak and prices start to come down.
Well, Javier Blas, Bloomberg opinion columnist, thank you so much. We appreciate your time and your insight. Guy, it's a fascinating story. I really recommend all of our viewers to come out and to just really check out this column, because Javier Blas, of course, we know is a veteran of the industry, but also very smart stuff coming out of Bloomberg opinion from him.
Well, it ripples into so many areas that we're focused on as well. You think about what happens in the housing market at the moment. We got very excited about lumber a little while ago. Lumber prices came back down relatively quickly, but it did put a crimp on the ability of the industry to be able to build houses. You think about, Javier was talking about reinforced concrete. That's definitely part of the building process. You put a concrete floor down, you're going to reinforce it. You want to build buildings, you're often going to put RSJs in, steel RSJs. I was talking to a buddy of mine the other day who works in the construction industry. They're getting prices that would normally, you'd say that price is good for a month. They're getting prices for 24, 48 hours. You want to buy it, you buy it now, and the price is locked in. That's the kind of sort of disturbance you're seeing in the market, and it ripples into just about everything. You think about steel, you look around you, it is absolutely everywhere. So it's going to be fascinating, Karini, to see where that demand destruction shows up.
Yeah, it really is, and it's not just steel. You're seeing this in commodities as well. The ramp up in oil, that's one of the concerns, especially from some of these energy CEOs. You're saying, well, we can't really predict prices. We don't know if we want to make those long-term investments and then see that 18-month ramp up that follows. So this is something that is very clearly showing up across the industry. Let's talk about more about those disruptions. That's all, of course, we're going to coming up next off the war in Ukraine. We'll look at supply chains with the founder and CEO of Interos, Jennifer Bisegli. She joins us next. This is Bloomberg. And answers now.
Keeping you up to date with news from around the world, here with the first word, I'm Ruchika Gupta. Senators on the Judiciary Committee are questioning Ketanji Brown Jackson, President Biden's nominee for the Supreme Court. At one point, she defended her decision to represent detainees of the Guantanamo Bay military prison.
The people who were being accused by our government of having engaged in actions related to this under our constitutional scheme were entitled to representation. We're entitled to be treated fairly. That's what makes our system the best in the world. That's what makes us exemplary.
If confirmed, Jackson would be the first black woman on the Supreme Court. A Russian court has sentenced jailed opposition leader Alexei Navalny to 9 years in prison on fraud charges. Navalny is Vladimir Putin's top critic. He's been detained for more than a year since he returned to Russia following a near-fatal heart attack involving a nerve agent. Navalny and Western governments blame that Putin's secret services. And Ukraine's President Volodymyr Zelensky has called on Pope Francis to mediate in the war with Russia. In a tweet, Zelensky says he told the Pope about the difficult humanitarian situation and the blocking of rescue corridors by Russian troops. Meanwhile, the Kremlin once again said that peace talks are going more slowly and less substantively than it would like. Ukraine accuses Russia of negotiating in bad faith. Shares of Nike are higher today. The world's largest athletic wear retailer posted quarterly results that beat expectations. That shows the company is overcoming struggles with its supply chain and the weakness in China. Nike sales beat estimates in all regions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg. Bye.
Ritika, thank you very much indeed. Nike, or Nike, depending on your position, maybe dealing better with supply chain headwinds now, but Russia's isolation could continue to pose disruptions. Basically, the question we're asking is, Nike had a pretty good story to tell last night on the call when it talked about the fact that its supply chains are starting to heal. But actually, if you look at the bigger picture, things still look pretty tough. Jennifer Pasegli, the founder and CEO of Interos, the firm monitors global supply chains, is here to give us an update. Jennifer, nice to see you here.
Good to see you.
Let's talk a little bit about where we are. Clearly, the pandemic caused significant damage to global supply chains. Now we have the Russia-Ukraine situation to add on top of that. Nike sounded pretty positive last night on the call, but broadly, how would you characterize the situation?
I would characterize it as quick moving and still not quite understood. The interesting thing about Nike and their earnings is that they had to jump on it. If you think about it, they were called out on their supply chain last year. So they've had months to actually, and it was elevated. It was elevated to the CEO level and to the board level. And more than anything, supply chain and choices around the supply chain and investments are being made by the consumers. And Nike's a perfect example of that. So if you fast forward to what's happening with the Ukraine and what you were just talking about in the previous segment, you're still at the B2B level, so businesses dealing with businesses, and they weren't looking at this. They were not trying to understand not just who they were buying from, but who those suppliers were buying from. And looking at Ukraine and Russia, if we're literally cutting off whole parts of our developed economy, which is what the sanctions are doing, where else do I go for titanium and copper and nickel? There aren't any places to go quickly, and that's what you're seeing happen right now.
Jennifer, I'm curious about the extra pressure that's coming from the war here. When you do start to see just the amount of exports that Russia has really created dependence upon when it comes to the rest of the world, do you start to see on the back of these new sanctions, on the back of this war, some of these new trade routes, these new supply chains kind of being redrawn around the world?
Well, I think to the point that was mentioned a minute ago, I think the last 24 months have just created, if nothing else, a wake-up call and the opportunity to get educated. Every company, every country in the world realized how simply hyper-connected they are and how reliant they are in the extended supply chain to countries and companies around the world that they simply had no idea. And so I think you've seen shifts in the supply chain over the last 24 months that are going to continue. There's sometimes that a global supply chain is not a good thing, and you're seeing that right now. Sometimes you really need a localized or a hyper-localized supply chain. You're seeing that in agriculture. This is not going away. And again, it's become a CEO problem and a board problem, and it's being played out in the court of public opinion.
How quickly does the situation stabilize?
Yeah. It's a magic question, and I don't know that it ever does, because again, we've been proven that so much of what's happening in supply chain is outside of your control. Where Nike won is they invested in technology, they had a cultural leadership shift, and they engaged with their suppliers. That is going to be an ongoing, never-ending situation for the time to come.
Okay.
Give us a little bit of a timeline here, a sneak peek into the future, if you will. How long does these supply chain issues really last? When can we expect some relief, and when can we expect perhaps a new normal?
Well, I think which supply chain? So if you think again about the last 2 years, you had the pandemic that happened 2 years ago, and then you just had 17.5 million people that were told to stay home in China last week that did it again. You had the ship that went sideways in the canal. You had multiple examples of cyber breaches with SolarWinds and Kaseya. These hits just keep on coming, so I don't know that anything ever finishes. I do think that what will change is that there are going to be technology investments in truly getting the transparency and the trust into the supply chain, and this conversation will be ongoing. That's what's going to happen, and it's happening today, and I fully expect 2022 into 23 you're going to see major investments in technology that make this better, because again, the consumers are making those decisions with their wallets and with their feet.
Okay, but let's just talk about it from a B2B point of view still, though, for now. How much is this going to cost to get supply chains to work again? How inflationary are we going to see? Is the situation going to be? Because that's what we're all trying to figure out right now. Stuff is going up. The consumer is definitely watching this happen. The consumer is watching just about everything that he or she buys go up quite aggressively right now. And supply chains are being largely blamed for that. So the consumer is understanding that this is happening. How quickly can companies start to make the changes that you're talking about to start and bring those prices down? Or is this going to be a continuously elevated inflationary story? Prices are just going to continue to go up because supply chains are broken. They're going to take a long time to heal. And as a result of which, this is going to be not a kind of multi-month story, but a multi-year story.
Yeah, I don't think it's an end of the world situation. I do think that when you talk about what's going to fix the supply chain, there are multiple supply chains. Even though there's overlap in industries, like aerospace and defense and oil and gas have very similar supply chains, but there has to be the investment. So to answer your question, there is technology that exists today to provide the transparency in the supply chain that companies need to make it better. I would argue that some of the challenge with inflation is simple uncertainty, because companies were lazy. We had very fragile and short supply chains that were built in the 90s all around this just in time, and now you're seeing that really rethought, and you're seeing the investment and the technology that's creating agility in the supply chain. That's what costs. It's the cultural shift and the advance of technology. But is this going to be never ending? It is.
So just to jump in. Yeah. A company's running with significantly higher levels of working capital right now because their supply chains are broken, so they're carrying more inventory in order to make sure that their businesses can carry on. Is that something that ultimately you see fading off? Do we see a destocking in certain areas because companies are basically hoarding at the moment? Or is it simply that they can't get hold of what they need? I'm just kind of wondering what you see happening within businesses.
I think it depends on the industry. So if you look at what's happening in the automotive, they're doing more about, they're going to build a car based on your request. So it's more of a just-in-time, made-to-order. So that'll smooth out some of the hoarding of inventory that you're seeing. There are certain other industries like retail where you might see them stockpile more to make sure that whenever any of us as consumers go to the store, we always have what we need at a moment's notice. So I think it depends on industry. Not every industry is made for hoarding. I think you're seeing it now, again, because that transparency and trust in the supply chain doesn't exist, because unfortunately, we got caught a little flat-footed when the sanctions and the crisis broke out.
Jennifer, we were just talking to Javier Blas in our last segment simply about the impact of tariffs on steel, for example. There are still tariffs in play between the United States and China. They've never really went away. They just went away from the spotlight. Can you speak a little bit about the tariff impact and the trade impact that might be playing into the supply chain dynamic?
Well, I think kind of all bets are off as far as who we were wanting to do business with, simply because, again, the sanctions in Russia are cutting off whole parts of the global economy in a way that we weren't ready for. And so if you look at what happened with Shell a couple weeks ago, they went public to say we have to continue to buy oil from Russia. We apologize for that, but we don't have the ability to make the change, and we're going to donate our profits. So I think if you think about trade and tariffs, some of the things that we might have called rules and some of the hard and fast decisions decisions about where we did and didn't want to do business and who we wanted to do business with may shift a little bit as we're trying to figure this stuff out. If you think about what's happening here in Europe, we're actually taking a step back from a fuel standpoint because they need to unhook from the reserves in China before they move forward and move into clean energy again. So I think a lot of those things are some of the tools that we can use to get out of some of the inflation and build the trust back into the supply chain and the global economy that we really need. Businesses simply cannot keep operating with this reactionary and whack-a-mole approach to figuring out the supply chain.
Do you think we're going to see more vertical integration as a result of this?
I do. I think you're going to see a lot of mergers and acquisition. And again, if you look at what's happening in chips, you see that that's happening from an automotive standpoint. And you are seeing folks that are either starting to manufacture their own, and then they'll spin those companies off later maybe, but it is natural tendency to try to control more of it. And you'll also see just a natural consolidation of some markets. I also think that still might be a point in time because it's a cultural shift and as the technology advances, and I can actually see transparency in my supply chain and trust it, then there's lots of opportunity, innovation, price competitiveness by having a larger supply chain.
Jennifer, great to see you. Thanks for stopping by. Really appreciate the time. Jennifer Bisegli, Interos CEO and founder. This is Bloomberg.
Let's get a check on the U.S. markets. Bloomberg's Abigail Doolittle is tracking the moves. Abby, a little more green.
Yeah, quite a bit of green here. Risk on flavor for the day for sure. Creedy, take a look at the S&P 500 up 1%. This is important because, of course, last week, the best week since November of 2020, up more than 6%. And this question of whether you should buy the dip or not, there is certainly the possibility of some more volatility ahead. But over time, that suggests that 6% gain in a week, a year later, that stocks will be higher. Certainly higher today, as are China tech stocks, up 8.5%. This after that 25% gain last week. So the dip buyers are out, really being helped out by oil being lower. It's not down in a big way relative to the moves we're accustomed to, but down 1.7%. So a little bit of relief that commodities are not pressuring that form of inflation stocks. But it's interesting. We have stocks having no problem with that 10-year yield at 237 and its highest level going back to 2019. The question is, will this backup continue? Last week, I showed a chart that suggested we could see yields go back down down into the range. That certainly has not happened yet, but let's take another look to see whether or not this resistance that we're seeing may hold. If we go into the Bloomberg terminal, we will see that the 10-year yield literally right on top of resistance. This range here, it's called a broadening formation. It tends to be bearish. That fact doesn't matter. The bigger question is, will we see yields go back down toward the bottom? If so, that means 1.65% or so. And you can see the RSI. It's right near its highs over the last couple of months. So there may be reason, Guy, to think more volatility is ahead for bonds, but maybe not to the downside, maybe to the upside. This, of course, after the worst quarter right now, the 10-year note on pace price its worst quarter going back to 2009.
It's been a tough time for fixed income. I think nobody would deny that. Abigail, thank you very much indeed. Bloomberg's Abigail Doolittle. Let's talk about what we've got for the next 24 hours. The earnings actually quite interesting right now. Nike I thought was fascinating last night. Now we get Adobe. I think that's going to be fascinating from the tech sector. We're obviously going to continue with the hearing, the confirmation hearing for Judge Jackson, looking for some headlines out of that. Crudy, what do you got?
Yeah, tons of Fed speak on both sides of the Atlantic. Fed Chair Jay Powell, BOE's Andrew Bailey, the Bundesbank, tons and tons of people, even the UK Chancellor Rishi Sunak giving his spring statement. UK CPI data, 10 cent. What isn't happening tomorrow, Guy? There's a lot. Coming up, though, let's talk about what's happening on BOP. Mark Esper, former Secretary of Defense under President Trump, joins Balance of Power with David Weston on Bloomberg Television.